What's going on, guys? Top 3 option plays for next week. As we can see on our screen here, we don't have that many companies reporting earnings, but there's going to be 3 in particular that we're going to be watching. So this is going to be a quick little video. So the first one is going to be Tilray, which reports earnings Wednesday before the market opens. Now this is a weed stock, so if you do believe in these types of companies, this is going to be a stock for you. As we can see, it is down quite a bit, so it could be a good dip buying opportunity if you just want to pick up some nice shares. And of course, you could just sell some covered calls if you have 100 shares of this stock. And it's going to only cost you a few $100 to own 100 shares of the stock. But if you want to play options, we could do some cash secured puts as well. Something that we're looking at could be a 1% return, which would be the $6 strike right here. 88% chance of profit, and we're collecting over a 1% rate of return. Yeah, so it's gonna be a 1% return in 1 week, because we're putting down $600 of collateral and making $6 per contract. So if you have a larger account, you can sell multiple puts. Say you want to sell 20 of these cash puts, because remember, these are pretty cheap, so you're gonna have to sell a bit more contracts in order to get a little bit more premium. As you can see, you can make $120 on $12,000 of collateral, and it's a very safe strike, $6 strike, and you have a really high chance of profit. And overall, our goal is around 1% per week, and this is going to help us achieve that goal. So next stock on our list is going to be Levi's. As you can see, it's a price point that's pretty cheap as well, only $20 per share. It's a clothing brand store, and we can sell some cashier puts for April 14th. They don't have as much expiration dates as we can see here, but the April 14th is going to be a 2-week expiration date, so we have to keep that in mind. So an $18 strike is going to yield us about over the 1% return, but as we mentioned earlier, it is going to be over 2 weeks, so it's about a 0.5% return over two per week, which isn't that bad, honestly. If you do 0.5% every single week, that's going to be a 26% rate of return annual, which is pretty good considering that the average stock market return is around 10%. So we can sell cash secured put at this strike, and this stock doesn't move that much, so we're not collecting that much premium. As you can see, implied volatility isn't that high, but an 18 price point is going to give us an 83% chance of profit, and overall, it does have some good support around the $18 price point. So next stock on our list is going to be WD-40. We're reporting earnings Thursday after the market closes. And as you can see, this is a more expensive stock. So selling a cash secured put on this stock is not going to really be feasible for most people. So we'll do a put credit spread on this stock. And as you can see, this doesn't have as many expiration dates either. So we're going to be doing the April 14th expiration date. And we want to be a little bit safe. So we could do like a 170 strike, possibly even the 165, but we'll sell the 170 just as an example. You could of course adjust the strike prices to whatever risk tolerance you have, but the 170 selling and then the buying of the 165 under it is going to turn it into a put credit spread, which is what we want. Because remember, when companies report earnings, implied volatility of these stocks go up, meaning the premium of the contracts are going to go up as well. So we can capitalize on the higher inflated premium by selling options, and we can do that in the form of covered calls, cash secured puts, or even credit spread. So in this case, we're doing a credit spread. We're receiving a credit of $110, and our collateral is only going to be $500. With a put credit spread, it is going to require a lot less capital, but the downside is you can lose your entire collateral. Whereas on a cash secured put, If you lose on the trade, you're just owning 100 shares of the stock at a comfortable strike price that we chose. So in that scenario, it's kind of a win-win situation. In here, it's either a win-lose situation, but we do have a nice chance of profit. It's around 80%, so very, very high win rate on this strategy as well, and it's perfect for smaller accounts. Now, if you do have enough capital, you could sell just a straight up 170, 160, or 165 strike put, and you're collecting some really nice premium on your capital. The stock does have a higher implied volatility than Levi's, so you are going to collect a lot more premium on these contracts. So that's about it. Quick video, 3 stocks we're watching for next week. Not too many companies are reporting earnings, so it shouldn't be that volatile of a week.